Hey YouTube, this is Bean Counter Dave with Grand Roofing, giving you some tips and tricks to help you run your small business. Now, I'm not an accountant and I'm not an attorney, so please run anything that you find helpful on this video past your professional to make sure that it's right for you and your small business. Let's get started. Okay, as a small business owner, you and I both know that timing is everything. And if you look at the calendar and it's the fourth quarter, well then there are several things you should be doing right now. I can think of 4 off the top of my head. Number 1, you should be updating your Quickbooks files. That's right, you should be downloading those transactions from the bank account into your Quickbooks and get all those transactions sorted out in your profit and loss statements. Because let's face it, there's a charge back in February of 2020 that you have no idea what it was for. And you need to get those downloaded. You're going to forget what those transactions were for last week or the week before that or the quarter before that. So let's get those updated right now. Number 2, Schedule 1, Part 2. This is a tax form that you should be looking at. Why? Because as a small business owner, you're probably either an LLC or an LLC with an S-Corp tax designation. Both of these will pass the profits onto your personal tax return. Now, once those profits reach your personal tax return, Schedule 1, Part 2 gives you the last chance to make some adjustments to that income. Let's take a look. Okay, so this is a draft of the Schedule 1 for 2020 from the irs.gov website. It's not yet finalized, but let's go through it. Since we're just focusing on small businesses, we'll skip around a little bit because some of these line items won't apply. So let's start with line number 12, health savings accounts. So deductions from your HSA contributions can be included in this line. Assuming you work for yourself and you don't have a Section 125 plan from an employer, you can contribute money to an HSA account for yourself with after-tax money. And you are allowed to deduct this amount from your income tax. Now keep in mind that you've already paid Social Security and payroll tax on this money, but this is a nice deduction to avoid income tax. The maximum that you can contribute is $3,550 for an individual and $7,100 for a family. The next line is line 14, deductible part of self-employment tax. Now on this line, any self-employed taxpayer that owes self-employment tax for the year may qualify for this deduction. Now self-employment income includes any of the following net profit from Schedules F or C, guaranteed payments from a partnership, or wages from an S corporation. Talk this line over with your tax advisor, as there's some tax planning that's needed to get the most out of this deduction. Okay, let's go over the next one, which is line 15, which is self-employed SEP, simple, and qualified plans. This is basically retirement plans. So the rules for this are very complicated. But if you've contributed to your own qualified self-retirement plan, you may be able to deduct certain amounts from your income, which is a double win. Setting up a self-employed retirement plan can save you a lot of money because the contribution limits are huge. So if you don't need all of your profits in your small business to survive on, and you have profits left over, consider setting up a self-employed retirement plan to offset those profits so they don't pass on to your personal account. The next line would be self-employed health insurance deduction. Under line 16, the self-employed health insurance deduction allows eligible self-employed folks to deduct up to 100% of health, dental, long-term care insurance premiums for themselves, for their spouses, dependents, and non-dependent children under age 27. Keep in mind there are 2 qualifications for this. Number 1, you can't have worked for another employer that offered a health care plan, or your spouse also through her employer could not have offered a health care plan that you could have been a member of. And then number 2, you had to show a net profit in your small business for the year. Line 19 is IRA deduction. You can deduct $6,000 as an individual, $12,000 if you're married, and you can add an extra $1,000 each if you're both over 50 years old. You need to have at least this much in income during the year to contribute, or that amount that you made becomes your limit. So basically, if you've made $6,000 in profit, then that is your max that you can contribute even with your spouse. But that's still a nice deduction that you can make to your income at the end of the year. Line number 20, student loan interest deduction. So student loan interest deduction allows you to deduct up to $2,500 for student loan interest that you've paid in the prior year. This deduction is limited to your MAGI, or Modified Adjusted Gross Income, and begins to phase out after $70,000 for single filers and $140,000 for married people filing jointly. And last but not least, tuition and fees deduction. So basically, if you're in school or your child's in school You can deduct up to $4,000 for qualified tuition fees from your income. This amount drops to $2,000 if your income exceeds $65,000 as a single filer and $130,000 for married couples filing jointly. Now, please remember, folks, that none of these tips and tricks are meant to cheat Uncle Sam out of any tax dollars. They're all perfectly legal deductions, and they've been set up very carefully by our legislators. And most of these are for very small businesses, because you and I cannot afford an accountant, a CPA, an attorney to go out and just research the tax code for us every year. You have to rely on bean counters like me on YouTube to go out and look for these deductions. And most of these deductions are not for the rich. They're for the small business owner, because as you could see through all the examples, these all phase out at a certain level of income. So they're for the small business. Take advantage. Okay, let's get back to the original list. Item number 3, you should be collecting W-9s, or you should be going out and finding the vendors that haven't supplied you with W-9s yet. Now, you shouldn't do business with a vendor that refuses to fill out a W-9 because they're trying to get out of paying taxes. And you don't want to encourage that, because the IRS is starting to get pretty stringent on small business owners that do not turn in W-9s. It's a $50 fine per occurrence. So you want to make sure and get on that. Now, a W-9 is a very simple form. It just has the name, address, social security number, or EIN number of the vendor. But you need to get it from them because they have to sign the bottom of the page. So make sure and collect that from them and get that turned into your accountant so they can turn them into 1099s and ship them out to the vendor. Now, you only need to collect it if you've paid them over $600 in a calendar year, and you don't have to collect it from them if they are a C Corp or incorporated. If they have Inc. after their name at all, you don't need to worry about it. And finally, number 4, ring the bell. Tax advisor. Find yourself a tax advisor that can help you implement some of the deductions that we've showed through this video. Follow some of the advice on this video. Get some of these items done before the end of the 4th quarter. Be ready for next year. And just remember, it's not only important to make a profit in a small business, but it's important to keep it too. Now, if you've liked anything in this video, please like, subscribe, make a comment. We'd really appreciate it. Have a great day.